Most people think they're investing. They're not. They're collecting random investments. One ETF their cousin recommended, another one they saw on YouTube, a few stocks they bought during a market rally, maybe a dividend fund they don't fully understand, a growth ETF they panic sold 6 months later. And after years of investing, they end up with a portfolio that looks more like a junk drawer than a wealth-building machine. The worst part? Most investors never realize the mistake. They think investing is supposed to be complicated. More funds, more sectors, more strategies. But if complexity created wealth, Wall Street would have made everyone rich already. Instead, the investors who consistently build real wealth usually do something much simpler. That's why I'm going to show you what I believe is one of the most practical 3 ETF portfolios you can build in 2026. Not 20 funds, just 3 ETFs. Each one has a specific job. Together, they create a portfolio designed to grow through bull markets, survive bear markets, and compound wealth for decades. Every ETF must have a job. The first ETF is your foundation. The second ETF is your growth accelerator. The third ETF is your income and stability engine. Together, they create something far more powerful than any individual fund could provide alone. Now, before I reveal the first ETF, there are 3 rules that make this strategy work. Ignore these rules, and even the best portfolio can fail. Rule number 1, stop trying to build a portfolio that impresses people. The average person thinks investing is about finding winners. The next Nvidia, the next Amazon, the next stock that turns $1,000 into $100,000. But long-term wealth is created by owning productive assets for a very long time. The biggest companies in America today didn't even dominate the market 20 years ago. The leaders changed. The technology changed. Entire industries changed. But one thing stayed remarkably consistent. The American economy kept growing. Businesses kept innovating. Profits kept increasing. And investors who owned broad collections of great companies benefited from all of it. Rule number 2, know what stage of life you're in. A 25-year-old investor and a 65-year-old investor should not necessarily build the exact same portfolio. Someone with 30 years ahead of them can afford to focus more aggressively on growth. Someone approaching retirement may care more about income and capital preservation. The destination matters, but so does where you're starting from. Rule number 3, never interrupt compounding. This is where most investors sabotage themselves. They invest during good times, then panic during bad times. But the biggest gains often come immediately after the worst periods. History has shown this repeatedly. Consistency is where real wealth comes from. Charlie Munger once said that building the first $100,000 is incredibly difficult because most of the work is being done by you. You're making the contributions. You're saving the money. Once the portfolio gets large enough, something changes. Your money starts working harder than you do. The snowball starts rolling. So now let's talk about the ETF that forms the foundation of the entire portfolio. VTI, the Vanguard Total Stock Market ETF, may be the closest thing investing has to a cheat code. Most investors spend years trying to identify the next winning company. VTI doesn't play that game. Instead, it owns nearly the entire publicly traded U.S. stock market. Thousands of companies. Large companies, small companies, growth companies, value companies, technology, healthcare, industrials, financials, consumer brands, everything. When America grows, VTI grows. And that's exactly why so many experienced investors build their portfolios around it. Think about what happens over time. 20 years ago, companies like Nvidia weren't dominating headlines. 30 years ago, Amazon was barely getting started. 40 years ago, Apple wasn't the giant it is today. The leaders changed, but VTI kept adapting. When one company becomes more important, it naturally becomes a larger part of the fund. When another company declines, its influence shrinks. The market constantly updates itself, and VTI captures all of it automatically. This is also the ETF that tends to help investors sleep at night. Historically, the US market has continued moving higher over long periods because businesses continue creating value, and VTI gives you exposure to that entire process. The piece that keeps the portfolio connected to the long-term growth of the American economy, but isn't designed to maximize growth. That's where the second ETF comes in is QQQM, not QQQ. They're nearly identical. Both track the NASDAQ 100. Both give exposure to many of the same companies, but QQQM has a lower expense ratio, which makes it a better long-term choice for most investors. When you invest in QQQM, you're buying many of the companies shaping the future. Artificial intelligence, cloud computing, semiconductors, digital infrastructure, automation, cybersecurity, advanced software. The technology's transforming how businesses and consumers operate. Companies like Microsoft, Apple, Nvidia, Broadcom, Amazon, Meta, the giants that continue reinvesting billions into innovation. Now, before someone says, but aren't those companies already inside VTI? Yes, they are, but not at the same weight. QQQM intentionally concentrates more capital into these high-growth businesses, and historically, that's produced stronger returns. Of course, there's a trade-off. Greater opportunity usually comes with greater volatility. When markets get nervous, growth stocks often fall harder. Many investors say they want high returns. What they really mean is they want high returns without volatility. Unfortunately, that's not how markets work. The higher the potential reward, the bigger the emotional test tends to be. That's why QQQM isn't meant to replace VTI, it's meant to complement it. VTI provides broad diversification. QQQM provides concentrated growth. Together, they create a much stronger combination than either one alone. There's one major weakness in many growth-focused portfolios. They become completely dependent on stock appreciation. In other words, the portfolio only feels successful when prices are rising. And that's a dangerous mindset, because markets don't move up every year. Sometimes they spend years going nowhere. Sometimes they decline. Sometimes investors lose patience. That's where the third ETF earns its place. SCHD, the Schwab US Dividend Equity ETF. It focuses on something very different. Instead of chasing the fastest growing companies, it looks for profitable businesses with strong balance sheets, healthy cash flow, and a long history of rewarding shareholders. These aren't speculative startups. These are established companies generating billions in profits. Companies that continue paying investors regardless of what financial news is saying this week. And that's incredibly important, because dividends change how investors think. When you're only relying on stock prices, every market decline feels painful. But when your portfolio produces income, you're getting rewarded for simply holding the asset, even during difficult markets. That's one reason dividend investing remains so popular. People enjoy seeing their money produce tangible cash flow, not just paper gains. And SCHD has become one of the most respected dividend ETFs because it avoids many of the traps that hurt income investors. It doesn't simply chase the highest yield. Instead, SCHD focuses on quality. Companies capable of increasing shareholder payments over time. That's a huge difference. A dividend that grows is far more valuable than a dividend that stays stagnant. Think about inflation. Everything becomes more expensive over time. Food, housing, healthcare, travel. A fixed income stream slowly loses purchasing power. A growing income stream fights back. That's exactly why dividend growth matters, and SCHD has built a reputation around that concept. Now let's look at what we've created using a balanced allocation. 40% VTI gives us broad ownership of America's economy. 35% QQQM gives us concentrated exposure to innovation and growth. 25% SCHD gives us quality companies producing growing income. A portfolio designed to benefit from multiple drivers of wealth creation. Let's start with just $20 per week. After 10 years, you would have invested about $10,400. Your portfolio could be worth around $23,000. Not life-changing yet. Fast forward to year 20. Your total contributions would be roughly $20,800, but your portfolio could be worth around $82,000. Now let's move up to $50 per week. After 10 years, you've invested $26,000. The portfolio could be worth around $57,000. And by year 30, your total contributions would be approximately $78,000. Yet the portfolio could be worth around $638,000. Over $500,000. Now let's look at $100 per week. After 10 years, you've invested $52,000. The portfolio could be worth around $114,000. After 20 years, you've contributed $104,000. Then comes year 30. Total invested, $156,000. Portfolio value, approximately $1.28 million. This is where many investors reach millionaire status. Through patience and consistency. While everyone else is reacting to headlines, you're accumulating ownership in some of the most productive businesses in the world. Just let compounding stack on itself. That's how wealth is built. Not overnight or through luck, but through ownership, patience, and time.